Hello, my name is Jesse Cortes. I'm the business development manager here at Park Street, and I'll be discussing navigating the U.S. beverage alcohol market for entrepreneurial brands today. To give you a little bit of background on Park Street, we're a national importer, able to supply distributors in all 50 states, as well as distribute ourselves in certain key markets, including New York, New Jersey, California, and Florida. We also provide a full assortment of compliance and logistics services, freight management, warehousing, accounting, and back office support. What we're going to cover today includes the U.S. regulatory framework for alcohol in the three-tier system, key considerations for launching a brand in the U.S., and some of the frequently asked questions I've received over the years from brands that are entering the market, just being in the industry. So the three-tier system is what everybody's heard about in the US. So this was developed after Prohibition. It was originally intended to protect consumers, but it was also a means to collect taxes in a reliable and efficient manner. So you have three different tiers of the system. The first tier includes any manufacturers or suppliers. That could be distilleries, wineries, breweries, anyone who's actually producing the liquid. Then you have tier two, which includes distributors, control state authorities. It's really the wholesale tier. Then you have tier three, which includes retailers, all types of retailers, whether they're on trade, off trade, hotels, restaurants, bars, liquor stores. And those are the ones to get it to the final end consumer. And no business can be involved in more than one of those tiers. So you have the producer, the wholesaler, and then the retailer. And taxes are taken out both between tier one and tier two, as well as selling it to the consumer. So the federal excise tax is usually paid upon import or whenever a product is removed from a bonded facility. State excise tax is paid normally in the majority of markets once a distributor sells it to the retailer. And then, of course, sales tax is paid by the consumer. And this whole system really acts as a system of checks and balances in the alcohol industry. So in terms of federal and state compliance, you have both corporate and product registrations. You have federal basic permit, as well as on the product side, a certificate of label approval. The acronym for that is a COLA. You'll hear that term a lot. Then on the state side, you have individual permits in each state to be able to sell to distributors. Park Street currently holds those permits in all 50 states to be able to sell to distributors. So once you have those federal approvals, including the main one is the certificate of label approval. So once you have that, you're actually able to import the product now and sell it. It's good on a national level to be sold in the US. And then before it can actually be sold to distributors in individual states, it's got to be registered in the state. And that's what brand registrations are. There's also a few nuanced states where you have to do price posting as well, where you post the price to the state on the retail and wholesale level. So here's an example of a label and some of the requirements outlined in red. So some of the requirements include a brand name, class type, statement. So that would be, vodka, gin, alcohol content, net contents. So in many other countries, 70 cl will be the standard size. In the United States, it's 750 milliliters. You also are required to have the U.S. health warning statements and the importer statement. So there's a few different requirements that are on the label. And then once that's been approved, you're able to sell it. Here's an example of an actual label approval. The current processing times for spirits are 9 days. Wine and malt beverages are 4 days. And you may not only be required to get a COLA, you may be required to get a formula and sample analysis. Those can take longer, especially the sample analysis, where you have to ship product in and actually have the TTB tested in their labs. Usually for a gin or any flavored beverage, you'll go through a formula approval before the COLA. Here's a map that's really meant to demonstrate that each state is regulated differently and follows different rules. In some states, the alcohol industry is largely operated by the government and controlled. Those are control states. In other states, it's more privatized and you can work with as many wholesalers as you want. Certain states lock you into one wholesaler. So every state is a little bit different. You kind of want to think of the US as 50 different countries, and every state is going to have slightly different regulations on what you can and cannot do. Now, to segue from the regulatory aspect of the industry to some things to consider when launching a brand in the US on more of the sales and marketing side, you want to formulate and write down a marketing plan. You want to be able to answer some of these questions. Who's the target consumer? Where do they live? What do they drink today? Where are they drinking it? How much are they paying for that? These are some of the questions you want to be able to answer, and you might not have all the answers right away. It takes some market research and some in-market sales to really dive into understanding your consumer. You also need to understand that you're starting out as a substitute. So from what they're currently drinking, they would be substituting it for your product. So you need a strong value proposition that resonates with the consumer in order to shift from what they're currently drinking to try something new. Another exercise you can do is a simple SWOT analysis, strengths and weaknesses, and compare that to your competitors. So determining retail accounts, the premise type and the size of account. There's pros and cons to both, on-premise, off-premise, independents versus chains. Traditionally brands would start out in the on-premise, maybe in some independent on-premise accounts, slowly grow those up and build some brand awareness there. And that would slowly transition to off-premise sales. Now with COVID, it's going to be a little bit more difficult to do that. Now it may be easier to get into independent off-premise accounts, do tastings. This is key for proof of concept during tastings, especially in smaller independent off-premise accounts. You can also do that in chains as well. You can build rapport and build relationships closer with smaller independent store owners, buying managers versus larger chains. And on the larger chain side, let's take Total Wine, for example. If they want to take your brand into multiple states, you have to have distribution in each one of those states. It's not that you can just think you can sell directly to them. You actually have to have a distributor in each one of those states. So it can be a little tricky. So one key aspect of launching a brand is making sure the brand works first in a micro market in terms of selling in and reorders. And what I mean by micro market is, one specific locality where you're selling into this area or city into key accounts. And first placements typically will need a sales pitch to an owner or a buying manager. And in these, say, off-premise, you're also going to want to make sure you support the brand in tastings and try to get any type of placement that you can get. But I wouldn't worry about order size or asking for too much investment from the retailers. You want to really just get in there and ask for placements, displays, and try to do tastings when you can. In terms of reorders are probably the single most important thing to evaluate the viability of a brand, both from a distributor perspective and a retailer perspective. And it's relatively better to have a smaller volume, but strong reorders from those specific accounts rather than a big sell-in with multiple cases, but no reorders. So that's something you want to focus on. If the product's not moving off the shelf, there's going to be no point for the retailer to reorder the product. And they may even have to sell it at discounts, which definitely doesn't look good for the brand. Here's an example of some in-store tastings. When you do these, you really want to try to find those accounts that have a high foot traffic and go in there during a popular time of day with consumers that have an intent to buy. And this is also where you can do a lot of market research. Do they actually buy it when they bring your product to the cashier? And once they ring it up and find out the price, do they put it to the side? It's too expensive. Do they actually go through with the purchase? You can get a lot of feedback on the product and liquid itself. So tastings are very important. Once you have this market research down, you know who your target consumer is, what they're buying, you're selling into accounts, you got reorders, you nailed down the sales pitch and the messaging of the brand. This kind of all combines to create a blueprint for when you look to expand into new markets or new states. And it doesn't mean it's going to guarantee, 100% that blueprint will work in every state. You may need to make some adjustments here and there, but at least you have something to work with moving forward when you're starting to expand. The key here really is just having flexibility, having a little bit of flexibility here when you do kind of have that blueprint for success going into new states and being able to adjust to the local market. When you're looking to expand to new markets, there's a few different choices you can make and considerations to make. You can look at the high-end image markets versus second-tier markets, franchise versus non-franchise states, open versus control states, which I touched on earlier, where control states are really controlled by the government and you're selling into the state government. High-end image markets really include any major metropolitan areas that you would think of: New York, Miami, LA, Chicago. So those markets are going to have a lot more competition, but they're also going to provide a lot more diversity in terms of demographics and a much higher population. In terms of franchise versus non-franchise markets, a franchise market is where you enter an agreement with a distributor and you're really locked in with them for life. We joke about it in the industry. It's kind of like a marriage without the option for divorce. You're really locked in, and unless that distributor releases you from that, you really can't switch distributors. These include, Georgia, Tennessee, New Jersey, and there's a few other states that are franchise markets as well. The distribution paradox. So this is a little graphic we put together showing David versus Goliath. David represents the small brand entrepreneur or the small supplier. Goliath are the large guys, the big brands. And you typically see, neither of them can get enough attention from their distributor. Distributors have some degree of freedom and control, but they're also limited by the needs of their customers. They still have to sell product. When looking at distribution options into expansion states, there's other options than just the national footprint distributors, which should always be considered, but you also have other top supplier distributors that may have, strong presence in a particular state or have some presence in a region of the US. You also have second-tier distributors, which typically will have a presence in, one city or maybe a few cities throughout a state. And they don't normally work with the biggest suppliers, so they'll work with small to medium-sized suppliers. And then you have alternative distribution options such as Park Street, where it's really an unbundled approach, meaning the logistics and warehousing, storage and deliveries, order fulfillment, that is all separate then from the sales. And so you actually control the sales. This is really beneficial, especially in the initial stages of a brand life cycle, in learning all about your consumers, defining that blueprint. So you have more insight and can do more market research. And many times this can be more cost efficient in the initial stages of the brand life cycle than traditional distribution. Some examples of strategies and tactics to increase attention at the distribution level. Of course, margins and incentives. As a smaller supplier, you might need to provide more margin to that distributor, as well as doing presentations, going to the general sales meetings and doing trainings with the salespeople and building your brand awareness with those people. as well as doing ride-alongs, spending a day with a distributor salesperson, going along with them to accounts, telling the brand story, building that personal connection, not only with the salesperson, but the account as well. And then in-market sales and working with brokers or brand ambassadors, someone who's actually more dedicated to your product and going out there to promote it and be in front of accounts. There are a few different sales models, and you really want to try and strive to get an above fair share of attention. There's the dedicated sales infrastructure where you're really just hiring a sales team or sales rep or brand ambassador full time, and or maybe part time, and that of course is going to get be more expensive, but you're going to get full dedication to your brand. A shared sales team, they might work with a few different brands, but the key behind this is as long as they're not working with a very similar product at a similar price point, you want to have some differentiation when working with a shared sales team, but that can be a lot more cost efficient and you can get a lot of exposure that way as well. When you are selling into accounts and you're launching the brand, you really, early on, you want to try to master this balance of push and pull in terms of pushing your product to accounts, but also consumer pull and consumer demand. If you have too much push and not enough pull, your product will essentially sit there, and going back to earlier, reorders won't happen and they'll have to discount it and they might not reorder the product. If there's too much pull and not enough push, it can be good to a certain degree because consumers are going to accounts asking for your products. But if the accounts over time don't have the product, obviously that's not going to be sustainable. It can be a waste of resources on marketing and sales. So it can be good in the initial stages where people are going to ask for your product. The accounts are ordering from distributors, so that can work. But if it continues over a period of time, that's where you'll run into issues. The key is to find kind of a balance of push and pull, which is very hard to do. But that's why we usually suggest doing a small test market, figuring out an effective method to create and optimize that push and pull factor. Now we're going to move on to some frequently asked questions that we get. How do I identify the right markets to enter in the US with my brand? I think the markets are a factor, but I think it's even more of a factor is really just supporting the market that you're going to launch in the right way. So if you're a small brand with limited resources, don't try to enter too many states at once. Just go into one local market, even just one city or a couple cities, and really focusing on key accounts there. You don't want to spread your resources too thin. You want to go deep rather than wide. Saying you sell in multiple markets and in multiple states, it sounds great in theory, but in practice, if the product's not moving, then that's not good, of course. As far as which market, it can depend on the relationships you have, whether you enter into a chain-driven market like Florida or an independent retailer-driven market like New York. There's a lot more to it than just selling to a distributor and then thinking they will sell the stock. You really have to do your research on each state, the distributor, the consumers, and really determine what fits your sales strategy and be able to adjust. I think that the main takeaway here is, regardless of the market, you have to be ready to support your accounts the right way, support your distributor partners the right way. What are blueprints for success that have worked for other brands? Kind of what we've talked about through this presentation. So going deep into accounts and really understanding what pricing works, what messaging works, determining who your target consumer is, and the correct messaging and brand story that really resonate with those consumers. Being agile to market demands, being able to pivot where necessary, whether that being adjusting pricing, who you're pitching products to, the brand message and marketing collateral versus being rigid and trying to force something that's just simply not working. The other key aspect I would say is differentiation, making your product, its value proposition and brand story differentiated enough. For example, Uncle Nearest whiskey has an amazing story, and they have a great brand story, and that's really helped the brand take off. What are common mistakes that brands make when first entering the US? Well, for one, of course, spreading your resources too thin, not properly supporting each market and taking on too much for your company to maintain or to support at one time, not investing enough in sales and marketing support. Another one would be, not listening to the market, not being flexible and listening to consumer feedback, and not being able to change strategy when the market dictates you to do so. And one more point I'll make is not doing research into new markets or distributors. A perfect example, a brand I knew a few years ago, they entered into a distribution agreement with a distributor in Georgia, not knowing that it's a franchise state and that they would essentially be married to that distributor. And it ended up being, a nightmare for them, a nightmare relationship, and it didn't work out. But they couldn't get out of that distribution agreement, and they couldn't appoint another distributor. And what ended up happening there is they had to leave that state because it just wasn't working for them. If they had done their research beforehand, they would have known it's a franchise state. Maybe they would have done a little bit more digging into the distributors that they were going to appoint, and look into their payment history, and also look into any brand references or brands that they've worked with and get their feedback as well. If you can do that and speak to other brands that have worked with certain distributors in the specific state that you're looking to work with them, that always helps as well. And that concludes the presentation today. Thank you for taking the time to watch the webinar, and I'm happy to answer any questions that you have.